The Fed is playing a game of musical chairs. We and all other investors in the economy are walking around a ring of empty chairs. Jerome Powell is playing and stopping the music, and the music is currently playing right now. All of a sudden, Jerome Powell announces to the game of players that he is going to stop the music in 2 minutes. Do you take Jerome Powell at his word? What's up, everyone? This is Brandon from Wealth Potion, and today we are talking about the Fed's rate cut. In case you missed the news, the Fed just cut rates, and it's kind of a big deal. Now, if you don't know what any of that means, that is totally okay, because today we're going to be breaking it down in extremely simple terms. We're going to be walking through what the Fed is at a very basic level. We're going to talk about what they did last week at their latest FOMC meeting. We're going to talk about what they said at the meeting and at the press conference and why that is important. And last but not least, we're going to be talking about what I'll be doing with my investments in light of that news and what I'll be watching for over the coming weeks and months as we head into the US election. So without further ado, let's dive in. So first and foremost, we need to have a basic understanding of what the Fed is. The Fed is the Federal Reserve. In other words, the central bank of the United States. When you need to go get a loan, you go to your commercial bank. When the commercial banks need to get a loan or the government needs to get a loan, they go to the central bank. And although the Federal Reserve does work very closely with the US government, it is technically an independent organization. We will be doing a very in-depth video all about the Federal Reserve and its very mysterious origins another time, but that's basically what we need to know. It is the central bank of the United States. What their goal is as the central bank is twofold. They have what's called a dual mandate. Those two goals are to maximize employment and stabilize prices. In other words, they want to make sure that the unemployment rate in the United States is as low as possible, and they want to make sure inflation is not as low as possible, but they want it to be close to their target inflation rate of 2%. To put that simply, the Federal Reserve is founded on a philosophy that the economy is healthy when inflation is 2%. If that sounds a little bit odd to you, then you might like the Wealth Potion channel, so subscribe and we will be talking about that more. But for now, let's just accept that premise that the economy is healthy when inflation is 2%. Now, why is it called a dual mandate? Well, firstly, because there's two goals, but perhaps more importantly, it's because these two goals sometimes conflict with one another. When the economy is running too hot, in other words, everybody is employed and the stock market is going up and up and up, that can create inflation, which can raise prices. So as employment gets better and better, inflation might go up. And the inverse is also true, which is where if inflation comes down too much, then the Fed believes that that will cause unemployment. We're not going to be criticizing that belief system today, but let's just accept it as true. The Fed wants to achieve those two things, 2% inflation and maximum employment in the United States. Now, the last thing we need to cover about the Federal Reserve is how do they achieve that dual mandate? And while the Federal Reserve does have an array of somewhat complex tools within their disposal, it really boils down to a handful of things. And one of the biggest ways that they influence the economy is through interest rates. So when you hear the Fed has cut rates or the Fed has hiked rates, that is what we're talking about. To get specific, what the Federal Reserve does is they change the target for the federal funds rate, which is a fancy way of saying they can influence the interest rate that commercial banks use when they're loaning money to themselves. Now, this is a silly example, but just to imagine for a moment, if one bank has $1 billion extra at the end of the day and another bank gave out $1 billion in loans, they could lend each other money to balance their books at the end of the day. This is also why the federal funds rate is sometimes called the overnight rate, because banks often have to do this rebalancing overnight. Again, a bit more complex than today's topic, but it's really important to understand that the Federal Reserve really only controls that single interest rate, which is what the banks use to lend to each other. However, the rest of the market, which includes bondholders, stock investors, etc., they look at the federal funds rate and it helps inform what they're going to use for their interest rates for longer duration loans. If you want to understand this a little bit better, I did post a video recently about the yield curve. I highly recommend checking that out. But again, to summarize it in simple terms, the Federal Reserve controls the shortest term interest rate possible, but that interest rate makes its way into the rest of the economy. And again, to connect this to your lived experience, if you ever go get a loan from a bank, they'll often use language like prime plus 1% or prime plus 2%. Prime is what they're talking about. That's that federal funds rate, and they are adding some percentage to that rate. Now, as mentioned, the Federal Reserve has other tools at their disposal, like printing money digitally, quantitative easing, other loan programs they can offer to banks to provide them with liquidity to prevent them from failing. Again, not the topic of today's video. What we're talking about is interest rates. I know I'm doing a lot of summarizing here, but it's really important. The Federal Reserve exists to maintain stable prices in the economy and maximize employment. And one of the biggest ways they do this is by raising or lowering the federal funds rate, which influences all other interest rates in the economy. Now, what does a rate cut do? When the Federal Reserve cuts interest rates, that lowers the interest rates across the economy. It doesn't happen instantly, but over time, your mortgage payments will get less expensive. Your car loan will get less expensive. The payments you make will decrease. And what that does is it accelerates the economy. It adds liquidity to the economy because now you have more money. You're paying less money in interest, and that is going to speed up the economy. Now, the opposite is, of course, is true when the Fed wants to slow down the economy. They hike rates. They increase the interest rate, which means that your mortgage gets more expensive, your car loans get more expensive, your student loans get more expensive, and then you have less money to spend, and that slows down the economy. I know that was a lot, but hopefully that explained in simple terms what the Federal Reserve does and how the interest rates impact the economy. If you have more questions about this, please do leave them in the comments. This is a new topic for a lot of people, and it's a topic that we will be spending a lot of time on here at Wealth Potion. All right, so that's what the Fed is. What did they do last week? They cut the interest rate, the federal funds rate, from 5.5% to 5%. In other words, they cut it by what's called 50 basis points. In other words, 0.5%. Why is this a big deal? Well, let's cover a couple of facts. Firstly, as we discussed, the Fed cuts rates when they want to accelerate the economy, when they think the economy is getting a little too slow, which we'll get into in a moment. But it's also important to look at the history of the Federal Reserve's rate hikes and rate cuts. If you will all remember, in March of 2020, when the world shut down for a bit, that's the last time that the Federal Reserve cut rates. They cut rates by 50 basis points and then another 100 basis points in a series of emergency meetings. And that was largely because the world was in an emergency and they wanted to accelerate the economy by lowering interest rates. Now, interest rates stayed at zero for a long time, and then in March of 2022 into 2023, the Federal Reserve started hiking rates, and that's where we saw interest rates go from 0% all the way up to 5.5%. Again, important thing to consider here is this is the fastest that the Federal Reserve has hiked rates in its existence. That period of 2022 to 2023 when rates went from 0 to 5.5%. So if you had a mortgage, if you had a car loan and you were thinking, oh my gosh, it just got way more expensive, you are not alone in thinking that. That is the fastest your interest payments have gone up in the history of the Federal Reserve, which is about the last 100 years. Now, why did they hike rates? They were doing that to combat inflation. Inflation, which is the rising of prices across the economy, the Federal Reserve, when they see inflation, they want to slow down the economy, and so that's why they hiked rates. Now, that brings us to last week, September 18th, 2024, the Federal Reserve held their FOMC committee meeting, and they had a press conference, and they announced that they are cutting rates by not 25 basis points, which is the usual amount that they cut rates, but by 50 basis points. I also want to point out a little sidebar here, which I just think is hilarious, that over 90% of economists predicted last week's announcement incorrectly. Over 90% of economists thought that the Fed was going to cut by 25 basis points, and they actually cut it by 50 basis points. So that maybe tells you a little bit about what I think about economists at large. But I digress. What matters is that they cut interest rates faster than what a lot of people expected. So you might be thinking, oh, that's great, Brandon. The Federal Reserve is cutting rates. That's going to lower my interest payments. That's going to lower the amount of debt that I have. That's great for the economy, isn't it? Well, yes and no. And that's where we need to start talking about what the Fed said. Now, if you're following with me so far, you can understand already how powerful the Federal Reserve is when it comes to impacting the economy. But it gets even better than that. The Federal Reserve is so powerful that what they say about their interest rate movements is powerful as well. And that's a concept in the finance world we call forward guidance. Literally, what it means is that the way that Jerome Powell, the chair of the Federal Reserve, the way that Jerome Powell speaks about future intentions in their interest rate policy will actually impact the economy. And it's quite simple to understand this, right? Imagine Jerome Powell goes up on the lectern and he says, we're going to keep increasing interest rates. Inflation is still too high. Well, if investors know that interest rates are going to go up, then they're going to change their investments, they're going to sell things, and they're going to it's going to become a self-fulfilling prophecy. And in the same way, if Jerome Powell says everything is amazing and we're going to continue cutting rates, then investors will start deploying capital because they know that rates are going down. Now, this is where it starts to get a little bit weird and where a lot of the discourse, quite honestly, in the finance world comes down to. It becomes this kind of game of chicken where if Jerome Powell says, yes, the economy is strong, then investors are going to say, does he actually believe that, or is he just saying that to make sure that the economy remains strong and that his words become true? And this becomes very clear when we look at what he actually said at the press conference. So I'm going to read out a couple of quotes. And again, the context here is that interest rates were 5.5%. The Fed cut rates by 50 basis points, meaning that they want to accelerate the economy. And they are doing that because the data is showing that the job market is not as strong as it used to be. And I'm going to read out a few quotes from what Jerome Powell said. He said, in the labor market, conditions have continued to cool. The unemployment rate has moved up, and the nominal wage growth has eased over the past year. So, for all intents and purposes, the job market is not doing as well as they would like. However, when he announced the rate cut, listen to the words he uses. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. In other words, Jerome Powell has one of the hardest jobs in the world because he has to go up there and bluff to the economy and to the American people because he cannot really tell the full truth. If he goes up there and says, the labor market is deteriorating fast, then everyone's going to panic, people are going to sell their investments, and the economy will actually deteriorate faster based on his own words. I know this sounds a bit abstract, so I'm going to make it very real with an example that hopefully you all can appreciate from your childhood. The Fed is playing a game of musical chairs. We and all other investors in the economy are walking around a ring of empty chairs. Jerome Powell is playing and stopping the music, and the music is currently playing right now. All of a sudden, Jerome Powell announces to the game of players that he is going to stop the music in 2 minutes. Do you take Jerome Powell at his word? Or do you think, okay, well, if everyone else thinks that Jerome Powell is going to stop the music in 2 minutes, I should be ready to sit down maybe in 1 minute. Now, here's the catch-22 is if you've played musical chairs, you can't just sit down right away. You have to wait for the music to stop. And that, I think, is actually a very powerful analogy of what's going on right now. Jerome Powell is saying, don't worry, everyone. The labor markets aren't so bad, even though we're cutting rates, which shows that the labor market might be bad. But do not worry. And so investors, while many of them are thinking, oh, shoot, the music's going to end soon, they cannot sit down just yet. They have to keep playing the game of musical chairs. It's not a perfect analogy, but hopefully that gives you some context around how much power Jerome Powell has when it comes to influencing investor sentiment and ultimately the US economy and the world economy at large. All right, this is already a long video, but hopefully that broke things down in simple terms. I want to talk about two big things that I'll be doing over the coming weeks and months. To be clear, this is not financial advice, but I want to share what I'll be doing in case it helps you all managing your own investments and how to think about the recent news around these rate cuts. The first thing I'll be doing is increasing my cash position. I think that there is a risk of recession, if we aren't already in one, in the United States, which can cascade to the rest of the world. And so increasing my cash position, that can mean many different things for different investors. That can mean selling some of your investments, but that can also mean not dining out as often. That can mean starting up a new source of income or launching a new product through your business. Whatever that might mean for you, I think it is prudent to have a bit of cash going into the US election and into 2025, because if there is a big dip, that is a great time to deploy capital and invest in assets at steep discounts. Now, again, I'm not predicting any big crash. And one of the hardest things to do is not just to predict a crash, but to predict when things are going to crash. And no one knows when the music is going to stop. But what I do think is clear is that with this change in the Fed's position on interest rates, what we also call a pivot, there is going to be a lot of uncertainty over the next few months, and I want to be prepared and just not stressing during that period. And the second thing I'll be doing is not about my investments, but I will be posting a lot more videos around this topic, about the Federal Reserve and its history, about forward guidance and how all that works, about central banking and what we did before central banks existed, and also some adjacent topics that I think are really relevant here, such as recession indicators that I will be watching for over the coming weeks and months. I'll mention a few just to get you excited so that you might subscribe to the channel. I'll be posting videos about the M2 money supply, which is how much money is flowing in the economy, which can be a great indicator for how the economy is doing and what's to come. I'll be talking about Warren Buffett's cash position, because Warren Buffett, who owns Berkshire Hathaway, has a record amount of cash and T-bills right now, which basically means that he's waiting for a fire sale to go and buy businesses and equities. And another one that I'll be talking about is insider stock trading. Another great way to look at where the economy is at is looking at the executives of large Fortune 500 companies and see, are they buying their own company stock or are they selling their own company stock? And spoiler alert, it's not looking too hot. So anyways, if you're interested in any of those topics, I highly recommend subscribing to the channel. I greatly appreciate it. And I also greatly appreciate the comments I've been receiving in my videos. It's not all been just, hey, great video. It's been constructive criticism. It's been questions. I love to have this dialogue with all of my subscribers because at the end of the day, this channel is to improve your financial literacy and hopefully allow us all to build more wealth for our future selves and for our future families. So thank you so much for your support, and I'll see you next time.